It's time to talk the crash. No, not that one. This one. Okay, so just think for a second. What have you learned already that makes you think the economy has problems? If you think, or if not, that this is a roaring decade, what could you maybe think about that is causing problems that we know is going to lead to a crash? I want you to think about that, but then there's also two other things I want you to think about as we go through and talk about this crash. The first one, so number 2 here, is what was the immediate impact of the Wall Street crash in 1929? Who is most affected at this stage? So who is going to hurt the most right after the crash? And then, what was the impact long term by 1931? Who was affected by then? Is it the same people? Is it different? But we got to start here with Herbert Hoover, who becomes president. So we have Harding, we have this silent cow, never really talked. Now we've got Herbert Hoover, a businessman himself. In his inaugural address in March 1929, he kind of alludes to this great decade. He says, "We have more cars, more bathtubs, oil furnaces, silk stockings, and bank accounts than any other people on earth. I have no fears for the future of our country. It is bright with hope." It's March of 1929. So here's the question. How do we get to this? These are shanty little shacks that are set up on the outskirts of towns where workers, common families, would have to live their lives for the next few years. In fact, they're called Hooversvilles because they make fun of President Hoover. But how do we go from the jazz age, or if you think it's a roaring decade, how do we go from that time period to this? There are some underlying problems in the economy. There are 7 big ones that I'm going to mention here. Here's what I want you to do in your notes, I think would be a good idea. I want you to think about who is affected here, or what is affected. Make 2 columns in your notes. Which would reduce sales and profit, and which would reduce workers or employees. So as I go through these 7, kind of put them in the column that you think they go in. So I have one column that is focused on sales and profit, another on workers or employees. And kind of add in some you might have in 1, some you might have in 2. But these are underlying problems that are going on during the 1920s that are going to kind of culminate in a lot of issues. So the first one, there is a decrease in the demand for housing. It slows and it declines, mostly because the people who wanted to buy houses have bought them. There gets to be a point where you can't keep going up and up and up and selling houses. And we get to that point by the end of the decade. So the first one is demand for housing slows. Along a similar line, the enthusiasm for buying cars and other goods like radios, that goes down too. So mostly everyone who wanted to buy a nice fancy car got one by the end of the decade. And radios. So the demand for it goes down. When we think about farming and agriculture, what happens, and to kind of keep it simple, agricultural prices fell. Well, farmers have to take out loans. Loans for seed, loans for any hired help that they have, for any kind of implements like tractors and equipment. So when the prices fall, it's hard to repay loans as a farmer. That's another underlying problem. If we think back to the businesses from the 1920s, I showed you this picture before. There are 2 things that go on in the business world. The first one is an unequal distribution of wealth. Just like during the industrial times, there was a few people at the top who had tons and tons of money, your Rockefellers, your Carnegies. In the 1920s, that's starting to happen again. You have a few people at the top of society who have a ton of money, and people down below don't have any. It's inequality. It's something that's brought up a lot today. The second thing to go along with this is that businesses are keeping high profits and high prices, but they're not sending those profits down to the worker to increase their pay. So businesses are keeping high prices, but when they start making a big profit, the workers down in the factory don't get a pay increase. And that's tough. Something else that happens has to do with a tariff. And a tariff is a tax on imports. So here's how this works. Let's say that we've got US over here and Britain over here. To protect our economy, we say, you know what, we should start making things in America, not importing them anymore. We charge a pretty high tariff on imported goods from Britain and from all other countries. That's nice. It helps our manufacturers and it makes people not want to buy things from the outside. However, the reverse happens as well. When we send exports out, that means that other countries don't want to pay from us because we're charging higher prices for them. So tariffs really don't help anyone. The last thing is that at the end of World War I, Germany was forced, because they're the loser of this war, was forced to pay a huge sum of money as a payment for losing the war, for doing all these damages that they did across Europe. Huge amount of money. Huge. They don't have enough cash to pay for it, so what they have to do is they take out a loan. Guess who they take the loan out from? The really successful country in the 1920s, the United States. That's great, as long as they can continue to pay it back. But there's no guarantee. So, 7 kind of underlying problems here. Demand for housing declines. The enthusiasm for cars and other goods slows down. Ag prices decrease. There's an unequal distribution of wealth. Businesses don't raise employee pay as profit goes up. There's a high tariff. And Germany has to pay for World War I through United States loans. All of this is going on at the same time that the stock market really becomes fun. So, the stock market is like this. This is a cartoon from the 1920s showing it like a roller coaster, which I think is a pretty good idea. So, here's how this works. When you buy stock on the stock market, what that is it's divided into something that's called shares. This is all really simple stuff. Shares are a piece of profit from a company. You can buy multiple shares and have stock. It's kind of a form of gambling because it's safe to do when the nation and the economy is doing well. So what you want to do in anything is you want to buy when the price of a stock is low, and you want to sell it when it goes higher. If you buy low and sell high, you can make money off of it. Well, let's say you really want to buy something, but you don't have enough money for it. There's something that has come about in the 1920s that you can use. Credit. And this is something that's called buying on the margin when you want to buy stock. Here's how this thing works. The idea is maybe you want to buy some stock that you don't have enough money for. Maybe it's $100 a share. You don't have $100, but you can put down $50. And you can pay that right up front. And you can get a loan then for the other $50 so that you can buy this stock. With the understanding then that as the stock that you have, that $100 of stock goes up and up and up in value, you can eventually pay back this $50 loan with the money that you've made. So hypothetically, let's say it goes up to 200. You have paid your $50, and then you've got this $50 loan. Well, if your stock now has gone up to $200, you can easily pay back that $50 loan. That's what buying on the margin is. That's good if you make a profit. It can be a problem, though, if you don't. The stock market is pretty popular. By the end of the decade, 10% of households are doing some kind of dabbling in the stock market thing. And from 1928 to 29, the value goes up, which means that there's more profit. In September of 1929, there's an increase of stocks sold, which means that as more is sold, the value of something actually goes down. Okay? It's just the way economics works. There are people who want to sell their stock before the value gets too low. They want to make sure that they can still make a profit on this stuff, so they start thinking. And this shows us that the stock market, people have realized, is that it's not going to continue to go up and up and up and up forever. There's going to be a time where it goes down a little bit. There's going to be issues where you kind of have to think about what you want to do and what you want to buy and when you want to sell and whatever. The big problem comes in October of 1929, specifically on October 24th. This is something that's called Black Thursday. There's about 12.8 million shares that are sold. This is huge. The previous record was a mere 4 million. That was a bad day. 12.8 million is horrible. So they trade, they go home. Friday they come back. The stock market is still kind of wobbly. They go home for the weekend, Saturday, Sunday, come back Monday. It's still not back to where they want it. And Tuesday they come in and think it's going to be solved. No. On October 29th, Black Tuesday occurs. This is the big one. 16.4 million more shares are sold. And this is when the bottom drops out. Because here's what has happened. Black Tuesday is the fallout. The stock market crashes. Most people have their shares wiped out, which means they can't sell, they can't pay back their loans that they took out when they bought on margin. It means that the profits that they were hoping to make aren't going to be made anymore. Here's the famous Broadway newspaper of Wall Street lays an egg, which puts people, this situation puts people in all kinds of horrible situations right off the bat. For instance, here's a photo that was taken outside of Wall Street where the trading is. Guy trying to sell his car, $100. He needs to sell the car. He's lost all of his money on the stock market. For the next 4 days, the value drops too rapidly to make a profit, and they don't have the cash then to pay back the balance on their loans for all of these investments. So people have to pay the debt back with whatever they have to sell. They have to sell their land, they have to sell their house, their car, their tools. Anything that is of value, they have to try and sell it off. Just like this guy. Well, if you're going to sell something off, you need to go to a bank. You need to have some money. So what people do is they go to the money, or to the bank to get their money, to pay off loans. They need to get some cash out. But the loans that are at the bank wants paid off. So here's the deal. You owe money to the stock market. So that means you have to either pay back the loan from the bank, or you have to figure out some other way to get rid of this debt that you have. If you owe it from the stock market, you have to pay it somehow. So you're going to go to the bank to get your money. If you already have a loan, say on a house or a car taken out with a bank, the bank wants that loan to be paid. So you have two things that you have to pay here. You have to pay your stock, but you also have to pay the bank loan. And the bank say, no, you're not getting any money until you pay off your other loan. Well, that's a problem, because if you can't pay the bank, then the bank can't get any money. If the bank doesn't have any money, then what's going to happen to the bank? The banks are going to close. And that sends the economy really in trouble. Here's a picture of a run on a bank. People trying to get their money out as quick as they can because they think the bank is going to go bust. It's going to go out of business, and their money is all just going to be literally flushed down a toilet. It's going to be thrown out in the garbage because it's not going to be worth anything. You can't do anything with it, and the bank can't give it out because everything's stuck in this mess. There's this vicious cycle then that starts to appear by the end. And this is where you get breadlines. It's because people go to the bank to get their money out, but the bank can't give them the money, so the bank closes. These people are left out without any food, without any money. Businesses then can't make any money because they don't have any money to pay. No one's going to buy the stuff that they're trying to sell. So, just to kind of put this in perspective, by the end of 1929, there are 600 banks that close. By 1933, there's something like 11,000 banks that are closed. This is a huge problem for Americans. And by 1933, 1 out of 4, almost 25% unemployment rate is going to hit. That's devastating. And that takes a lot of work to get it back. So let's go back to these questions. Okay. Specifically, these two. What was the immediate impact of the Wall Street crash in 1929? Who was most affected at this stage? Think long term then. What was the impact by 1931? And who was affected by then? You should have picked up on these things that are going on immediately, and then some things that might occur long term if you can kind of put some pieces together. So what ends up happening in the 1930s, starting in 1932, is the United States government has to try and put Humpty Dumpty together again. And Franklin Roosevelt is going to be the president who's going to try and attempt it.